Good to have you with us this morning. Thanks for joining us. Hope you had a great weekend. Let's begin this hour with the latest inflation numbers in this country. While the annual rate of core inflation eased for a fourth straight month, a slight increase in the monthly pace could keep the Bank of Canada from cutting interest rates next month. But let's start with the headline consumer price index. It rose 2.7% from a year ago. That was in line with base rate expectations and an improvement from the previous month's reading. Now, it represents the fourth straight month of that rate running within the central bank's target range. However, when you look at a three-month average of the core inflation rate, we did see a bit of a rise there, and so some are wondering if that will keep the Bank of Canada on hold when it has its June 5th meeting. Now, remember, to pivot to easier policy, the Bank of Canada Governor Tiff Macklem has talked about needing to see sustained easing in core inflation. Ahead of this data today, most economists on Bay Street were expecting the Bank of Canada would cut rates by 25 basis points next month, which would start a new easing cycle. Just looking in the market this morning, it looks like right now participants are seeing a more than 55% probability of a Bank of Canada cut next month. And we were reminded, by the way, this morning of the impacts from the hiking cycle as well, with mortgage interest costs and rent once again the biggest contributors to the annual rate of change in inflation. For more on this news and for the market perspective, let's bring in one of our regular guests, Bryden Teich of Avenue Investment Management, here with us in studio. Nice to see you.
Nice to see you. Good morning, John.
Any takeaways from this latest inflation reading?
I try not to parse the month to month, or, I think soon we'll have the week to week inflation numbers coming out. I think the general trend, as you highlighted, is inflation is easing from the rates that we had seen the last couple of years. I think my read through on what central banks are going through is that they just want to hold off on easing until they absolutely have to. And as long as the economy is kind of okay and inflation's gradually coming back to, around their target, I don't think they're going to be in a hurry to cut rates. I think that's one of the surprises, at the end of last year, to see how the market was pricing in all these cuts. If you just think of the incentives for what they had to go through, missing the inflation, raising rates really high, very fast, I think they're going to be very slow to unwind this. And so, you're in the ballpark of what that inflation number has been the last few Bank of Canada meetings. I would lean to saying, I think the inertia says they're probably not going to cut here. And I think until the Fed really starts to signal that they're about to go, I think there's incentive for the Bank of Canada to just hold here.
What's the connective tissue between two central banks in different countries?
I think if you look at what global growth is, if you look at Europe, if you look at China, if you look at Canada, we're much weaker than what's going on in the U.S. And so the preponderance of that means that the U.S. is more likely to keep rates higher for longer. And I think that the risk for other central banks is they start to ease policy quicker, which then you see reflected in the currency getting weaker, which then will increase a fear that, inflation is now, 12 or 18 months away from coming back. And so I think that's the risk, is like, if there's no reason to start cutting because the economy is still kind of okay, I don't see why there would be a rush to start cutting. I know people want there to be cuts.
Yeah.
And I think Canada is unique in that we have this 5-year mortgage cycle where we're now coming up to 4 years from 2020's level. 2021, 2022, you're going to have a lot of people resetting at much higher rates in Canada on a 5-year. So that is a headwind for growth for sure. And so they'll probably want to get in front of that, but I don't see why they'd have to cut in the next meeting.
And right now, if you're going to look at other data points that come in, if you've got another hot jobs report, theoretically, those are the kinds of things you're alluding to, that the Bank of Canada doesn't necessarily want to be moving towards a pivot if they're not quite at the finish line on inflation and you're still getting some resilient economy data points coming in.
Yeah, I think the risk by far is that they start easing here and we do get inflation taking off 12 months from now, 18 months from now. We have a minor recession, more fiscal policy, and then the central banks are in, take what they were going through the last 2 years, multiply by 10. Because if you lose hold of inflation and you let it start to take up again, rates are going much higher, which is a much more disastrous scenario. And so I think by being sort of conservative on the cutting front here and just saying, hey, ease up, there's no need to be cutting, I think that's the best course to take. But I don't know if they'll I don't know if that's what the course they're going to take.
And what do you think investors should make of all of this right now at a time when the TSX is sitting at an all-time high?
I think they should ignore most of this, like this inflation and what the central banks are going to do. I think the economy continues to be okay. I think the U.S. economy is still stronger than in other parts of the world. I think that asset markets have had a run here, I think much higher than I think most would have expected even after last year. And so we're in a you could say we're in a great environment because the economy is good, earnings are good. The higher we go, the more dangerous it gets that you have a big retrace to the move that we've had. So we don't spend time focusing on the month-to-month inflation numbers and what the central banks are going to do. At some point, they will ease policy. We don't know when that's going to be. We don't have the ability to predict it. So we would rather focus on companies that we like, what's doing well, what's not. Let's focus on that. That's where we add value, not in trying to know the inflation numbers for next month.
We'll talk about some of your stock picks coming up, but just in terms of the macro story of the Canadian stock market, some people have argued that if inflation is a lingering issue, that some of our sectors act as a hedge against that. Would you buy into that idea?
Yeah, I would agree with that. I think you've seen that energy has been strong this year, but some of the material sectors are doing well. You touched on gold on your intro as well. All of those definitely have positive tailwinds for the TSX. On the other side, you could say the global economy appears to be slowing, specifically if I look at China, Europe, and Japan. A slowing global economy is not good for cyclical parts of the stock market 12 months out. So what the stock market is experiencing is the benefit of the last 6 months of growth being strong, profits being strong. Looking out 12 months from here, I think the picture gets a little bit muddier.